Hello, this is Doug Gerlach from iClub Central. Welcome to our Lunchtime Stock Club webinar. Today is Monday, May 9th, 2016. Glad you could join us today. We're going to be taking a look at a stock of interest, take a look at where the market is year to date. Here are some words of wisdom from one of our greatest legendary investors. And as always, look for your input. If you have stocks that you're interested in and would like to share with the club, please feel free to use the questions box to type in your comments as we go along. Before we get started, let's review our housekeeping. If you're having any sorts of technical problems, please contact GoToWebinar directly right away via the phone or on their website. We are operating now with a high-speed internet connection, and all signs indicate that my voice is traveling out to you along with our video presentation. But if you can't hear me at any point through the presentation, if the graphics are choppy, if the audio is dropping in and out, we recommend that you don't run any other programs on your computer, particularly those that are sitting in your system tray that might be running in the background and interfering with the transmission of all the webinar data. Don't connect using Wi-Fi if you can help it, and you can always listen using the telephone. The instructions for calling in are in the GoToWebinar invitation. A reminder that last month GoToWebinar dropped support for the desktop version of their GoToWebinar and GoToMeeting application for Windows XP, Vista, and Mac OS X 10.8 users. Now those users have the Instant Join app, a browser-based application to use instead. So if you haven't noticed that or if you need help, please contact the GoToWebinar folks for more on that. You can still participate, but some of the features are no longer supported. For instance, you may not be able to listen to the webinar using your computer. You may need to dial in. If you're using the Google Chrome app, it's the only one that supports audio through your PC, the voice over IP capabilities. The questions box in the GoToWebinar applet is where you can type in your questions at any point. I'm monitoring those questions live, and I'll do my best to answer them and respond to your comments as we go. There's a brief handout of today's presentation that you can find in the handouts tab there of the application. Download that. It's a PDF file. You should be able to open it and print it very quickly or save it and refer to it later for reference. Our schedule of upcoming webinars can be found on iClub.com. Click on the Learning tab. Our archives are there as well. We're a little bit behind in publishing the archives, but hopefully we will get those back up to date later this week. So you can find out everything that we've got going on there on iClub.com. And we'll also let you know on Facebook if you like us at iClub Central on your Facebook account. We'll give you occasional updates and news about webinar archive releases there on the website. So here we are in May, the middle of May, and boy, what a market year we've had so far. Here is the year-to-date market performance for the three market segments that I like to watch. The light blue line is the S&P 500, which is up 0.8% year-to-date, almost 0.9%. So it's declined, and then it's come back a little bit, and it's retraced a little bit as of May 10th here. But we are just about flat year to date. The red line is the Russell 2000, which is down about 1.8%, and the greenish line is the Europe, Australasia, Far East Index. That is the index of large cap stocks in the developed world outside the U.S., a good proxy for watching the international markets, and that's down about 2% as well. So a lot of trials and tribulations of the market so far this year. And of course, right now, as we are in the end of the earnings season of first quarter earnings, the large cap market has been very active. When we look at the PE ratio, we see that it's actually been at a pretty elevated level. It's actually gone up since the 2011 bottom out period there. Following the financial crisis, and that PE has been steadily climbing back up. And you can see there that where we are right now, the PE has only been higher than this level a few times in the history of the market, going back to the 1800s. So the PE is actually up a little bit since last month. Last month we were at 20. Let me double check that number here. We were at 22.6, and now we're at 23.8. So the PE ratio has gone up quite a lot since last month, and that means that either the P has gone up, the price has gone up, the earnings could also have gone down. What's the cause of it? Well, we know that the P, the price of the S&P 500, is pretty much where we were at the beginning of the year. The earnings, however, is where we're running into a little bit of trouble. So the earnings have gone down. The price hasn't dropped correspondingly, and so the PE is up. If we take a look at the S&P 500 earnings, you can see that they have indeed, on the far right, you can see that little parabola at the end where the earnings have been declining down to $87.12 as they were reported as of last week. So that puts them below the prior peak prior to the 2008 financial crisis and market meltdown, and also higher than the peak that they reached last year, the year before. So we've seen this contraction in earnings of the S&P 500, and so that's where a lot of the market watchers have been paying a lot of attention. How are the large cap stocks that make up the S&P 500 faring? Well, we can write off the energy industry stocks, particularly those involved in the oil industry. Bankruptcies are probably on pace in that sector to reach all-time highs because of the continuing drop in the need for oil here in the U.S. But the S&P 500, as we looked, is flat year to date. It had been down 10% earlier in the year, so we've actually recovered that 10% plus a little bit. And the EFA and Russell 2000 down about 2% year to date. And that's a pretty strong recovery for the Russell 2000, coming back from bear market territory, where it was down more than 20% off of its 2015 all-time high. Still hasn't gotten back to that level, but has made a lot of progress in that. Now, I mentioned earnings season, and that's something that I like to keep an eye on. 75% of the S&P 500 have reported their first quarter earnings, and the total earnings are down 7.5% from the same period last year. Total revenues down 1.9%. But when you look at what analysts were expecting, 71.4% of companies beat the analyst earnings estimate, and 56.4% beat the revenue estimates. Certainly the decline of the US dollar, the exchange rate, has been a little more favorable for some multinationals, and that's helped a lot of S&P 500 companies. And the outlook for the second quarter is probably for more of the same. Most analysts are looking for growth, if we see any in 2016, to come from the third and fourth quarter. But as you can see here, with 71% of companies beating the analyst estimates, that the market was pretty negative, had a lot of low expectations built in for the S&P 500's first quarter. And that is why I believe the market has not performed so terribly, is because expectations had been set so low that when the market exceeded those low expectations, it kind of raised everyone's outlook a little bit and made people think, all right, well, if things are not as bad as they could be, then maybe they're pretty good. And again, this is the kind of logic that emotionally driven markets and market watchers engage in and indulge in. Those of us who look at the long term, look at these short-term results and say, well, this is as unexpected or as expected as it may be. This is perfectly normal. This is what we expect to see, this volatility and a lot of short-term teeth gnashing over how the market's going to perform in the short-term basis as we focus on the long term. But we're not buying the market, we're buying good companies at good prices, and we're going to continue to do that. We're going to continue to look for opportunities in the market. We're going to continue to try to find good companies that are selling at reasonable prices, buy them and hold on to them for the long term. You know, there was a lot of prognostication going on at the start of 2016 about where the market was going and how the economy was holding up. There were job figures that came out last Friday. Again, there are a lot of people who play Chicken Little and claim the sky is falling, but by and large, the numbers are not as bad as they could be. They're not as good as they could be. They're somewhere in the middle. They're not necessarily just right, but they aren't raising a lot of cause for alarm about the state of the economy at this point. So a lot of phases of the economy still in recovery, still in expansion mode, some retrenchment in some phases where some of the economic indicators are pulling back a little bit. Certainly manufacturing, industrials are performing just about as we expect during these types of situations. They're adjusting capacity, they're adjusting their payrolls to accommodate demand, and that's just all part and parcel of the economic cycle of expansion and contraction that we see. So if we talk about, well, are we still in line for a bear market? Are we still in line for a major sustained correction and sideways market? Turn to Peter Lynch, who talked about predicting corrections and how investors might or might not be able to use their predictions about where the market was heading. And he noted that far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. If you look back at the chart of the market year to date, or look at the 52 weeks of the market, we see the market heading into correction territory. We see the times when the bears might have been celebrating because of that correction and prove their thesis that the market was going to be down for a very long time, and then the market recovered. So we've already in the first half of 2016 seen the market fall and seen the market recover, and we're back to where we were when we started the beginning of the year. And if you're going to agonize over every drop in the market, you're going to be spending a lot of time not being productive when it comes to monitoring your portfolio and watching what's happening in the market and acting accordingly. Peter Lynch also said, I can't recall ever once seeing the name of a market timer on Forbes' annual list of the richest people in the world. If it were truly possible to predict corrections, you'd think somebody would have made billions by doing it. And again, this is Peter Lynch pointing out the futility of trying to time the market. And I can think of a lot of investors who might be frustrated this year because they were looking for that correction. They pulled their money out of the market when it went down, and now they're sitting around, or before it went down, and now they're waiting for the recovery to take hold, and the recovery's already happened. And so all they did was put money into probably into an asset like cash that doesn't earn very much, and are thwarting their own long-term efforts to build a portfolio. From our perspective, if better investing, and as part of the iClub Central family of companies, we know that reducing risk can be helped a lot in your stock portfolio by holding on to quality companies and holding on to them through down markets and waiting for the markets to recover and those companies to see their share prices go up, because we're focused on the fundamentals. So we continue to try to find those excellent companies, and as they outperform, and invest in them with an eye to the 5 to 10 year horizon of those companies. Well, that's my take on where we are in the market right now. Just like the investor advisory service, every month their investment comments typically end on that same note. Here's what's going on in the economy, here's what's going on in the market, and as always, we're looking at individual companies and trying to find the best opportunities we can. So this month, we're going to take a look excuse me, at one of the companies featured in the Investor Advisory Service newsletter. This is our top performing stock newsletter, one of the top 6 or so newsletters of the last 20 years as tracked by the Holbert Financial Digest. So our approach is long-term, it's proven, and our analysts are top-notch when it comes to generating interesting and productive ideas for stock investors, utilizing that better investing approach. And we're going to take a look at the Bank of the Ozarks, ticker OZRK, recommended in the May issue of the Investor Advisory Service. It is a regional bank headquartered in Arkansas. About half of its branches and offices are there, and then the rest of their branches are spread out roughly equally in Georgia, North Carolina, and Texas. The current price today, it's around $37. It was $40 when we covered it in the Investor Advisory Service. That issue came out at the end of April, the May issue, and the price in the issue in the stock study was just under $41. The current PE is 17. The current yield is 1.7%. It's been as high as $55, and the buy price was set in the stock study in the May issue at $45.80. Using an assumption of 14% earnings per share growth, the projected total return at the $40 price was about 19.4%. Now, part of Bank of the Ozarks' strategy is to make acquisitions. And they've got 2 pending acquisitions that are going to add more than 60% to its total assets for a bank in Georgia and another with branches in Florida. And those are expected to close in the first half of the year. It's a very strong balance sheet. The bank ratios like the efficiency ratio and the net interest margin are very strong for the Bank of the Ozarks. So it's come up on my screens because of its growth profile. The revenues last year were just under $500 billion, so it is a smaller financial, but that means that it does have a lot of growth potential built into it. Now, what's interesting, as you can see, the price is down $3 to $4, and the reason for that we'll talk about in a minute. Here is the graph, and you can see that trend. I'll point out that in the 2000, 2007, 2008 period, over here on the far left side of the graph, interestingly, for a bank, there is no big drop-off here during the financial crisis. So the bank was still pretty small at the time, did not have a lot of exposure to the types of assets that had dragged down many financial companies coming out of it, still performed well, and has been on this trajectory of expansion and growth on a fairly consistent basis. Still a pretty small bank, definitely a regional bank, with $6 or $7 billion in assets altogether, if I recall correctly. And that 14% earnings projection looks to be pretty supportable. The 10-year sales growth for the bank, 19.3%, and the earnings growth, 18.8%. A little uptick in 2011, followed by a downtick in 2012, which was still higher than 2010. So things definitely moving along in a nice direction. Now, as I mentioned, the prices come down quite a bit, and this is due to comments made last week at an investment conference where a short seller who works for a firm called Muddy Waters presented at a conference and claimed that the Bank of the Ozarks had made too many construction loans in real estate markets that seem to have peaked, including the New York City and San Francisco area. And he said, when there are downturns in real estate lending markets, their balance sheet really could come under severe pressure, and that stock is down from the 40 to $41 at the time as a result. Well, let me just finish my thought there. So interestingly, our analysts in the write-up in the Investor Advisory Service noted that regulators have cautioned banks against over-reliance on real estate loans, particularly loans on commercial real estate. And total real estate loans did comprise 89% of its portfolio as of December 31st, 2015. Loans on commercial buildings were 38% of the total, with construction loans making up another 35%, and residential loans made up the remainder of total real estate loans. And our analysts said we would be concerned if not for Bank of the Ozarks' extremely conservative lending guidelines. Its construction loan balances are just 51% of the cost of the projects and 43% of the estimated value. Conservatism appears to be part of its culture and history, as Bank of the Ozarks is one of the few banks in our memory to be roughly flat during the disastrous 2008-2009 years, in which many banks had to be rescued by the government. So this kind of counters what the short seller said last week. Yes, if you look at their construction loans altogether, there could be downturns, but the fact that the loans are such a relatively small percentage of the value of those properties, the total value of the projects that are being financed, seems to indicate, again, as our analysts have pointed out, that the bank is actually a very conservative lender in these markets that are perhaps a little more aggressive, and that would counter. That's our analysts counter to what the short sellers have to say. Needless to say, the short seller probably owned a lot of shares of Bank of the Ozarks before he made those comments, and has ridden them down and generated a little bit of change. Now, late last week, two members of the board of Bank of the Ozarks made some pretty significant purchases of the Bank of the Ozarks stock. So obviously, in an attempt to counter the statements of the short seller, they put their money together and increased their ownership. Now, what's interesting about that is that they are putting their money where their mouth is, and it's their money that they're using as directors on the board. They would not be doing that if they were not very confident, I suspect, in the future of the company. So it definitely presents an opportunity, perhaps, and a case study to look at what happens when short sellers make negative comments about these small company stocks. Here are their 52-week trend, so you can see the price as high as $55 and now pretty close to a 52-week low at $37. I think they got down to $33. They're below they took a dive below their 50-day moving average. They've been riding below their 200-day moving average for some time now. The relative strength in the money flow indicators also are approaching the bottoms, and you can see on the far right over here, you can see the increase in volume as investors got rid of their particular shares. Let me just highlight those. Yeah, you can see the volume over here coming into this week even. Very, very much increased volume that you don't see very much for this particular company. And indicative of, I'm sure, what's going on with the shorts. Now, it's interesting that our IAS analysts picked another financial stock. We don't find a lot of financial companies in a growth market approach. These companies typically have a lot of debt, right? Because they're loaning out money, they're bringing in money, they're borrowing money, they're They're lending money, they're borrowing money from their customers, in effect, to put in their bank accounts, and they tend to pay higher dividends. So we don't see the growth profile that you would see with technology or healthcare or biotech companies in many respects. The regulatory environment has changed, so these companies have to have a lot of money invested in safe assets to provide for a stable balance sheet. And so that means they have a lot of assets that are working not to propel the company's growth, but to provide the safety net in case business turns bad, the economy turns bad, their loans turn bad. So there's a lot of assets that are not generating a high return. So it's interesting. But as I've been doing screening the last couple of months, the types of companies that keep turning up in my growth screen, where I'm looking for growing companies at reasonable prices, have been the small regional banks and also real estate investment trusts. We have a couple of REITs that we cover in our two newsletters, the Small Cap Informer and the Investor Advisory Service, and a couple of banks. And so I think that if you were interested in Bank of the Ozarks, it would be useful to compare them to a couple of other peers, including Columbia Bank, which is a regional bank in the Seattle Pacific Northwest area, usually lauded as one of the top smaller banks in the country, and South State Bank, which is in the Carolinas, which is another a little more aggressively growing bank. They're acquiring branches in the Carolinas and expanding outward in that region of the area, taking advantage of the somewhat faster economic growth that's happening in the Carolinas as they're becoming an increasingly popular retirement destination. So the economy down there has been moving along. The technology industry is taking hold. So hopefully that bank can take advantage of some of those trends. So I would suggest it'd be an interesting experiment or interesting project to look at Bank of the Ozarks as it compares to these two banks. The Investor Advisory Service also covers Signature Bank, which is a New York-based bank. I wouldn't really put it in the same category. They cater towards high net worth individuals, so they're way outside the sphere of operations of Bank of the Ozarks, Columbia, and South State. But some of the things to look at include the net interest margin, which is the difference between the yield received on loans in the security portfolio that the bank has, and compared to the interest paid to depositors. The efficiency ratio, which is the relationship of non-interest expenses divided by total revenue. The percentage loan loss reserve, how much the percentage of loans that are set aside as the loan loss provision, and then also the percentage of non-performing loans or the percentage of non-performing assets, and banks may report one compared to the other. And see how these three banks stack up as you are looking for candidates. Three of them are smaller regional banks, but they service different areas of the country, and I think they might be all three of them might be interesting candidates. I cover Columbia Bank and South State Bank for the Small Cap Informer, and Bank of the Ozarks, as I said, was just came out of our Investor Advisory Service newsletter. There's a question from Jay about the analysts in the Investor Advisory Service. iClub Central is a subsidiary of Better Investing. So I'm the president of iClub Central. We are a wholly owned subsidiary of Better Investing, which is the nonprofit investor education group. At iClub Central, we make tools, newsletters, and websites for Better Investing members, for investment clubs, as well as for non-Better Investing members, for individual investors who are fundamentalists at heart. So that is our business at iClub Central. And two of the products that we produce are our newsletters, the Investor Advisory Service newsletter and the Small Cap Informer. Now, the Investor Advisory Service, actually, both of those newsletters I serve as the editor-in-chief for, so I'm responsible for the production. I'm responsible for the education, the marketing that goes into them. I'm responsible for editing them, making sure that they are written in reasonably good English whenever possible. The Investor Advisory Service has been published since 1972, and it has we have a relationship with a team of analysts from the firm of Provident Investment Management, which is a Michigan-based money management firm. And the principals of that firm produce the investment analysis. So they pick the stocks and do the write-ups for the Investor Advisory Service. Now the people on that team at Provident are probably names that you're familiar with if you read Better Investing magazine. It's Scott Horsberg and Dan Boyle and Miles Putnam. So they also write for Better Investing magazine, but they also produce the analysis for the Investor Advisory Service. So they serve as the analysts for that newsletter, and they have complete autonomy over managing the portfolio of stocks and making the picks and setting the buy prices and producing the stock studies. And that is what they've been doing at that firm for 45 years. And Scott has been doing it for more than 20 years, and Dan has a good chunk as well. So they have a long history, and that's just a little bit about our relationship with Provident vis-a-vis the Investor Advisory Service newsletter. So yes, they are paid. It's part of their job to do that stock research and to make those picks. And they are the firm in the United States, the money management firm that knows the better investing approach inside and out better than any other. I'm pretty absolutely certain of that. The founders of that firm were Ralph Seeger and Maury Elvacrugg, and Ralph was a trustee of Better Investing since the 1960s until his retirement about 10 years ago now, and he passed away 2 or 3 years ago finally. But until the end, he was an advocate for the better investing approach and one of our leading educators. So that's just a little bit about the Investor Advisory Service. You can find more at investoradvisoryservice.com. Well, we do have some time. If you have any stocks that you'd like to take a look at, please feel free to share them with me. I have our handy toolkit ready to go. Here is the, just to take a look at Bank of the Ozarks here. You can see the profile. We've looked at Columbia Banking before. I think they are in my my portfolio here. Well, maybe not. But I'll show you Columbia Banking. Again, they've had a short, a little bit of a down quarter. You can see in the most recent quarter, and they certainly, you see that 2008 to 2009, they certainly were affected by the financial crisis, but recovered quite well and have gone on to grow revenues and earnings at a pretty good rate after that time. So they've been a pretty consistent participant in the recovery of the economy in the Pacific Northwest. And then South State Bank is a little more aggressive, a little bit more. You'll see their history is a little less, a little more erratic, perhaps. But again, their downturn in 2009 was not the end of the world for them. They never went to loss territory. Big recovery in 2010, sort of averaged out between those 2 years. And then since 2011, you can see the earnings just growing very consistently, which we think is a pretty good sign of where they're headed in the future if you focus on the last 5 or 6 years of their business. But certainly a lot of banks in that 2008, 2009, you really saw them struggling to come out of it, accepting the TARP money, getting back on their feet. But these banks seem to have been performing pretty well. So I think they've got a lot of prospects ahead of them. Yeah, Dick mentions Air Lease and Gilead seem to be struggling lately. Air Lease has been reported earnings, and again, just I think Air Lease is just continues to perform well. Air Lease is the airline financing business. They're they actually have reported their first quarter. Can't recall offhand. It was not, to my view, it was not terrible. Their order book is something like 87% filled through 2017, so they continue to chug along. And if you look at their non-GAAP figures, they've had some, one of the reasons that their comparisons last year that see the earnings are flat is because they actually sold planes the year before. So they had some income coming in outside of operations. If you kind of take that out, things look a little better. I'm still pretty optimistic about Air Lease. All in all, I have been reducing. You can see the trend of PE ratios really declining, and I've been continuing to project higher PE rate, or I'm sorry, lower PE ratios going forward. You can see that if we look at their PE ratios in the last 3 years, they've been in the 12s, right? So the P ratio is low as 12. In the last 52 weeks, though, it's been as low as below 10 down to 9.8. And again, the high PE ratio in the 52 weeks was 17. And you can see that, again, represents a contraction from, we'll eliminate the 2011 results from 21 as those numbers continue to contract. My take on Air Lease is that the valuations are going to continue to go down as the company is increasingly seen as a financial business as opposed to a transportation or even a rentals and leasing industry business, and that's going to dictate a much lower PE ratio relative to growth than other companies. So I'm continuing to factor in some PE compression over the next couple of years, even with some good bottom line growth that I think is going to continue to drive the company. But I think you have to factor in that contraction of PE ratios in order to make sense of Air Lease's results as they go forward. eGov, again, I haven't looked at their most recent quarter yet. We do track Air Lease and we track eGov. Oops, I'm sorry, got it wrong. eGov is the ticker, NIC is the company. But it looks like their earnings in the quarter were up 41% on 11% sales growth, which is pretty good. So as I said, I haven't reviewed the company yet, but if you look at their quarterly trend graph, and we'll look at it on a quarterly basis. Let's get rid of the limit to 52. You can see their profits, their pre-tax profit growth kind of ratcheting all over the place. It smooths out when you look at it on a trailing 4 quarters basis. But my observation of the earnings and profit growth at eGov is that those quarters tend to either be very positive or very negative, and over the trailing 12 months and year to year, it tends to fall into line. But there seems to be a lot of short-term volatility. It has to do with their business, which is providing primarily web-based transactional websites for government agencies, municipal, county, state, and even federal websites. So their job is going in, placing bids on contracts, getting those contracts, executing those contracts, and then placing bids to renew those contracts. So they're constantly out there, and no states are making long-term contracts. So when they put contracts out to bid, they're for typically if they're for only a couple of years, and then there might be a renewal provision built in, or the renewal might go out to bid again. So they are working very hard at spending a lot of time placing placing bids, expanding their business. And as happens, sometimes another provider comes in and undercuts them, and so they'll lose that contract. And so it's kind of a tough business to be in, because you have a lot of customers, a lot of states, a lot of towns, but you're constantly battling to keep the business. We think that they do a good job of it, but it means that there is some short-term variability in their quarterly results, and that's just something we try to keep an eye on. I think also if you look at the PE ratios of eGov, you'll see a similar trend towards a contraction of PE ratios, 40, 41, 41, 38, and we'll eliminate the 52 as outliers, 33, right? So the lowest high PE ratio of the last 5 years was 33. The lowest high PE ratio of the last 52 weeks is 30. I like to refer to these numbers up here, and the lowest low is 20, just under 21, which again is lower than any of the lows here. So I think when you get down to looking at the total return over the next 5 years, you need to incorporate the contraction there. And so I would probably lower my 30 PE, my 20 PE a little bit lower, and to see where things were headed in the next couple of years. Current price is actually a little high compared to the 52-week high and low. It's just under 19. It's been as high as 21. So its low is 14.50. So again, there's nothing on my radar screen for eGov at this point that makes me think that that their fundamentals are shifting over time. We just want to continue to watch those trends, and certainly the most recent quarter earnings were showing some pretty good growth, and so pending further analysis, it looks like not a company that I'm looking to kind of get rid of anytime soon, although the growth rate is going to be pretty slow for compared to many other companies, just because of the nature of the business. But the government always has to be providing these services. They're looking to provide top quality web-based services. It reduces the need for labor, reduces the need for branch offices, for instance. So this is probably a pretty good business that they're in to go as things go further. Walter asks about AAOI. This is a fiber optics company, or Applied Optoelectronics. We started covering this one pretty recently. It's a pretty new business. And they're not, and again, very aggressive, a small business, $189 million in sales. You can see the good sale profile. You can see that they went public in 2013, and so there is a little bit of a sense of this is a new business, and definitely something that we want to watch out for. We started covering it, I believe, in March. That's when we started covering it in the small cap Informer. They are fiber optic network products. That's their business line. They've got facilities in Texas, Taiwan, China. They manufacture analog and digital lasers. And they have a proprietary fabrication technique, which it really helps to set them apart. We know that the fiber optics business tends to be highly cyclical. Network, everybody wants high-speed internet, but the providers of internet services don't want to upgrade the existing copper lines to provide faster experiences, because it's just very expensive to string fiber optics. And not only to string it to the poles, that's not so bad, or to deliver it underground, but to deliver it from the poles to customers' homes tends to be very expensive. Now, Google is changing all this up with pilot projects around the country where they're delivering fiber optic high-speed internet connections to homeowners in various communities, and people are very happy about the speed and the service that they're getting. The major providers of internet, which tend to be internet services, which tend to be the cable companies and telecom companies, don't like this one bit, that Google's coming in and using their poles to string fiber optic cable, using their rights of way, and undercutting them on price and delivering a much faster product. But with the increasing number of people cutting the cable, so to speak, which means people are no longer signing up for cable TV, but instead streaming via their telephone provider or via their internet provider, movies and programming via Netflix or Amazon Prime or other characteristics, other companies. That's a very positive trend. Verizon, in fact, or I'm sorry, Comcast, in fact, had a controversial data usage cap that they more than tripled recently, because so many people were complaining if you're streaming a lot of programming, you are using up this bandwidth, and Comcast was taking heat for advertising, a practically virtually unlimited amount of data that you get with your annual subscription or with your monthly subscription, and then calling out certain customers for exceeding a data cap that was not very well promoted. So they just agreed to extend that, and I think part of it was because the government agencies starting to look into the advertising of your high-speed, unlimited internet, and then you find out that your internet is not actually unlimited at all. Again, the profit margins on a GAAP basis growing out of nothing. So definitely an aggressive stock, but at this point, I think it's one that, again, it's new to our small cap informer universe, and one that we'll be looking at more as we go into the future. I see that a couple of people have asked, Dick and Park have asked about Gilead, and we follow it in the Investor Advisory Service newsletter. I don't follow it particularly on my own. It always shows up in our screens as companies that we think are that appear to have the characteristics that we're looking for in a growth portfolio. Let me and I think we just, I'm trying to see when we I believe that we recommended it, the analysts recommended it not too long ago, but I can't find it recently. But Gilead, it's just it's a phenomenal story, and that's part of the problem, is that it's done so well, and you can see they were kind of chugging along, doing admirably, but the last couple of years, since 2013, they've seen a really aggressive growth track, and that's obviously not sustainable. You can see that in this stock study, I've got a 10%. I plugged in a 10% future growth rate, which I figure is very, very, very conservative. Let's go ahead and see if there's a more recent quarter available. Yep. So a little bit of a downturn in the first quarter. Again, I don't follow the company, so I can't speak to what might be going on there. And you can see the P ratio is just coming down and down and down and down and down. And I just think that it's just at such a low level, current PE of 7. I think it's going to be pretty easily exceeding that over time. Obviously, this stock study is one that needs some work on it. So don't look at any of these results as particularly meaningful. one of the problems is that one of their products is so effective, it's a cure for a disease that people were taking, that people were looking for treatment options for. So if you've got a drug that appears to provide a cure for an ailment that previously was requiring monthly treatment or daily treatment via medication, that's great for society. For your business, it's a hard act to follow. You need to come up with replacement treatments for other ailments. So I think that's the price of success for Gilead to some degree, is their ability to deliver medications that work so well that they reduce the need for those medications in the future. So that's just a very top level, some thoughts on Gilead. I would point out the contracting. So in other words, these PE ratios have been just gradually getting a little smaller, getting a little bigger, but getting a little smaller, getting a little smaller, getting a little smaller. And so I think your analysis, if you're looking at Gilead, from my perspective, I would be factoring in much reduced PE expectations in the future in order to determine what the likely upside is. And again, this is a company that that has been growing so well and just performing well on a fundamental basis. And the price has just been hard to find, hard to follow along. If we look, I'm going to look real quickly and see what the analysts say on the internet in terms of the forecast for Gilead. So you see earnings of $12, $12.30, $12.97, $12.95. Over the next couple of years so I'll just plug that in, 12.97. We'll do the next 3 years. So you can see analysts are really look like they are looking at growth that is much subdued over the next couple of years. And that's, part and parcel of being a $32 billion company for sure. But if we're looking at 5 to 10% growth, that's going to change things from a growth investor's perspective. So you need to kind of be careful with your expectations. A simple trend analysis is not going to work quite so well for a company like Gilead. All right, another question on F5 networks, which I don't cover in our small cap newsletter, but let me take a look here. So software company, again, some earnings have been lagging, so I want to understand a little bit more about what's going on with that, and I guess that's the problem, isn't it? Earnings down just about 5.7% in the third quarter on a GAAP basis. I wonder. Let me take a look here real quick. Yeah, doesn't look like it's one of the companies that is tracked on a non-GAAP basis. If we look at the, go ahead. Let's look at the analyst estimates for F5, 545, and 621. So, again, looks like there's still some positive growth coming out of there. Analysts pulling back to maybe 12%. You see that kind of intersects. So the historical earnings growth over the last 10 years has been closer to 25%, sales growth closer to 19%, but at 12%, that seems to be around the consensus of what analysts are looking for the next couple of years. So a matter of contracting growth, but if we look at our quarterly trend graph, we'll see, yeah, not not the prettiest graph there on a trailing quarterly basis. In fact, earnings, sales, and pre-tax profit. Well, the earnings over here, the pre-tax profit growth has really stalled and hit below zero. We've got multiple quarters there of declining growth. So those are all kind of warning signs for the business. But again, they've been there before. So and then have recovered, and now we're seeing that downward trajectory again for 1, 2, 3 quarters in a row. So want to understand more about that particular presentation there as we go forward. So Diane asks about Cal-Maine, which is the largest shell egg producer in the country. I've looked at this company a long time ago. I haven't looked at it recently. We're in sort of an egg shortage mode. I don't know if that's still going, but here is the company. And you can see not the most consistent results, but a $1.5 billion company is judged by sales in 2014, still waiting for 2015 results coming in, I think. So the third quarter ended February 29th, so on a very odd fiscal year. So end of May will be their fiscal year, so we won't see that until July, August. So some variability in earnings, not the trend that we like to see in terms of and the sales growth. It's about 12% a year, which is not too bad. You can see they've had some real positive growth in the most recent couple of quarters, which is okay. If we look at analysts, let me flip back to my NASDAQ website just to see where the analysts are looking at in the next couple of years if they cover it. So we have 2 consensus estimates of $7 in May for this year and $3.55 for next year. Makes me wonder if there might be some one-time results that are incorporated in some of these quarters here. But if we plop in $7 just to kind of see, yeah, that's where the analysts are seeing things for the whole fiscal year. Only 2 analysts, though, making estimates, so not a very widely covered company. And I don't know what to make of the $3.55 for the next year, so which would put it back. Interesting. I think that would put it back in the realm of the longer-term trend. No. Yep, somewhere like that. So definitely something. This is not a slam dunk. I want to invest in this stock based on what I'm seeing right now. Definitely require a little more legwork to understand why the high variability of results, because we like consistently, and what analysts are looking at. What are those numbers there, and what are the factors impacting this business beyond the demand for eggs in the country. All right, well, we are right at 2:30, so let's wrap it up. I will point out that on May 19th, that's a Thursday at 1 p.m. Eastern Time, as part of the eMoneyShow.com, I'm presenting a short presentation. This is an online webinar presentation entitled Build a Defensive Stock Portfolio in 5 Steps. And then in May, that weekend, I'll be at the Better Investing National Conference in Chantilly, Virginia. That's in the DC area near Dulles Airport. So I hope to see many of you there. And then in June, I'll be in the Northeast Ohio chapter delivering a half-day presentation on June 18th, 2016. I want to thank you for joining our Lunchtime Stock Club today. We'll look forward to seeing you next month in June and at any of these events as we go forward. As always, you can always write me at gerlach@iclub.com if you have questions, and I'll do my best to get back to you. And otherwise, I hope you all stay the course in the current market. Remember that what happens in 2016 doesn't necessarily mean that 2017 can't be a much better year or a much worse year, but we simply know that by some point in the next 5 years, the market is going to reach a new high from where it is today, and we're going to continue to find the best companies that will help our portfolios reach those new highs as well. Thanks again. We'll see you next time.